Hey everyone, welcome to this week's episode of the Project 10X Weekly Roundup, where we go through the most interesting crypto, finance, and tech articles hitting the media in the last week. So, to kick things off, I've got a webpage from the Reserve Bank of Australia, and it's on measure of consumer price inflation. So, consumer price inflation is currently at 0.9%. So for those that don't know what CPI is, it's basically a measure of the average change over time in prices paid for by us consumers for a market basket of consumer goods and services. So it's essentially supposed to be a measure of inflation. But as I'm about to show you, that is perhaps not the measure that we should be using. So here we've got 0.9%. Seems like there's no inflation at all. However, according to Investopedia, as a cause of inflation, an increase in the supply of money is the root of inflation, though this can play out through different mechanisms in the economy. So if an increase in the money supply is the cause of or the root of inflation, then we should have seen a lot more inflation than 0.9% given Australia's printing policies in the last 12 months. So if we have a look, this is one of the ways that I like to measure inflation. And I tweeted about inflation and CPI this week. So if you want to know more, check out my Twitter. I'll leave the link in the description below. But basically, it's the M2 money supply. So the Australian money supply, the amount of these cash and near cash convertible money or checking deposits or stuff like that has grown by 12.9% year on year in December 2020. So that's a huge amount. So we've actually printed 12.9% more money. So what that means to tell me is that inflation is probably closer to 12.9% than it is to 0.9. Now, on Investopedia, they say M2 is closely watched as an indicator of money supply and future inflation, and as a target of central bank monetary policy. So when the central bank, like the Central Bank of Australia, prints money, there's an increase in the money supply, and we've seen that 12.9%. So there was actually a tweet from Anthony Pompliano, or the Pomp, who says the politicians are about to inject another 1.9 trillion into the economy. Buckle up, asset inflation, time for takeoff. And basically all he's saying is that as the money supply increases, as the central banks print money, you're going to see a rise in asset prices. Things like housing, things like commodities, things like the cost of bananas, for example. You're going to see a rise in equities, that sort of thing. So I just want to take you to this next page, and it's basically commodity prices. So we saw from the RBA, Reserve Bank of Australia, that the CPI was 0.9. From the money supply, we saw that it was roughly 12.9%. Now, I think commodities are a fantastic way to see the rise of inflation. And when I talk about inflation, I'm talking about the destruction of your buying power. So you have $100 in your bank account, and if inflation is 12.9%, you can buy 12.9% less goods than you could before there was inflation. So if we look at the commodities, the price of gasoline, petrol, has gone up 108% in the last year. Oil up 81%. Gas, gas heaters inside your home, 48.65%. Metal, iron ore, up 83%. Palladium, up 33%. Silver, up 77%. It's astronomical prices. Now, where we will see it, and I certainly have seen it, is in agriculture and lumber. So soy or soybeans, 67% increase. Cattle, so your red meat, 25% increase. Coffee up 22% or 18.25%. You've got cotton going up 43%, and the list goes on. You've got orange juice here up 10%. That's an Australian staple, right? How can orange juice go up 10%? It's crazy. And meanwhile, you've got the CPI at 0.9%. So I think we all need to do a little bit of digging and go, is it really 0.9%? Me personally, going into my local Woolies, I see that the price of a Doritos pack of chips went from $4 to $7. And you might be saying, what sort of bag of Doritos are you getting? And you know that I'm getting the party packs. So let's have a look at corn. Corn is up 47%. Well, that will explain it, right? So just be mindful of this and mindful of what's going on in the economy, because those dollars that we're keeping in our bank account are slowly getting devalued on the down low by the increasing money supply. Furthermore, there's an article here, food prices are soaring faster than inflation and incomes. And you see this in third world countries where, for example, Indonesia, tofu is 30% more expensive than it was in December. In Russia, consumers are paying 61% more for sugar than a year ago. That is wrong. 61% more for sugar. As a sugar lover, that shouldn't be the case. That's wrong. But, you know, in our economy, and it's a lot easier to not see the effects of, you know, these commodity price increases for the time being, because it's all being absorbed in this chain that it goes from, you know, the farmers to us. But slowly we'll notice that those prices start to get passed on to us. It's just that we've got these chains that can absorb it in the short term. So then, as I was saying, inflation impacts houses. As I'm sure everyone would be aware now, house prices record sharpest increase since 2003. And if we have a look at the chart, so in the month of Feb, they went up, what's that, 2.3-ish%. That's the highest increase that we've had since Feb in 2003. So it just goes to show the inflation rate there even further. And that's in 1 month, 2.3% in 1 month. On that basis, you're going to see a 24% price increase if it keeps going down that road in 1 year. So it's just something to be mindful of. And to top it all off, we've had rate hikes. So the Australian government 10-year bond, you would have been receiving 0.8%, but now it's actually gone up even higher. So you'd expect these rate hikes to go higher as the economy recovers. So as the economy opens up again, you expect the rates to increase. But it was the speed and severity of the movements, the likes of which haven't occurred for decades, that stunned onlookers. If sustained, it will lead to higher borrowing costs, because as rates increase, it costs more for us to borrow, right? But the people or companies that will be hit hardest, in my opinion, are tech stocks. And in the article, it goes on to say companies such as Tesla, which produce little profit now, but promise big returns down the track, are the ones most at risk from a rise in long-term interest rates. Tesla has lost a quarter of its value in the last month, which is unreal. I was listening to a Real Vision interview today with Teddy Valley, founder and CIO of Prevail Global. And he mentioned that there could be a reduction of the price to earnings multiple of these tech stocks of 30 to 50%. So depending on how much they earn, especially if they're not earning anything, if there's no profits in the company, this may mean a reduction of 30 to 50% in the share price of these tech stocks. And really, we're starting to see that now in Tesla. So if I bring up the Tesla chart here, they've gone from a high of, let's have a look here, from about 890 down to, it hit 600 and currently at 621 and the market closed. So you're seeing a quarter of the share price, maybe even closer to a third of the share price being wiped off. And that comes down to discounted cash flow. So the way that these companies are valued. So a discounted cash flow is a fundamental analysis technique, and it includes an input for a 10-year bond. And as the bond yield, as the interest rate begins to rise, these stocks don't look as profitable or attractive as they once were. So the higher the interest rate goes, the more that these tech stocks, like your Amazon, your Apple, your Microsoft, your Teslas, will all get impacted. And mind you, Apple's done, 100% in the last 12 months. They've doubled their share price. So it just goes to show that with low interest rates and the right market conditions and money printing going berserk, you're going to get them flying off. But as interest rates start to increase, then you're going to get the stocks going lower. So then moving on to crypto, we've got 100 artist NFT collaboration sells out in minutes, increases 7x in price in 24 hours. And this is common in the NFT space. For those that aren't aware what an NFT is, I'll give you an example. So it just means that it can't be, it's unique and can't be replaced by something else. So that's a non-fungible token. A fungible token is something like Bitcoin. You sell one Bitcoin and then you get one Bitcoin back, you've got the same thing, right? Whereas a non-fungible token is a one of a kind. So perhaps a one of a kind trading card, a one of a kind painting, it's non-fungible. So I want to give you a few examples of non-fungibles. So for example, I've written some down. Non-fungible tokens could be something like ID and certificates. So in the future, we'll see our ID, certificates, degrees from uni, all of these things that can hold unique information about a particular good, asset, or person will become non-fungible tokens, and they can be used in things like identification and certifications or licenses and qualifications and things like that. You can also start to use these NFTs, and we will see this in sport, games and concert tickets, because these counterfeit tickets are a huge issue, and the immutability of blockchain technology prevents these things from happening, so counterfeiting. So with tokenizing sports game tickets and things like concerts on the blockchain, it's a perfect use case because it's just a unique NFT that no one can replicate. A few pieces which we're seeing here is like artwork. So someone can buy a creation, a unique or one of a kind creation or one of 50 trading card, and proudly showcase it in that virtual space of theirs, knowing all about its full history, on information on that asset. The final one is gaming. So you have these marketplaces inside games, and 80% of games make their money from the actual in-game purchases. And you have these in-game currencies and in-game items that you can not only purchase, but you can transfer across to other games. So NFTs will be useful in that you can prove that you have this, this perhaps clothing item or a sword or something like that. So it's really fascinating, and NFTs are taking off in the art world like crazy. So you've got Beeple, who's a NFT artist. He sells for a record $6.6 million as bidding for every days at Christie's hits 2.2 million. For those that aren't aware, Christie's is an auction house and one of the biggest in the world. And this, I believe, is the first artwork that has sold at an auction house, and for $6.6 million nonetheless. And it went for 100 times more than its original price. So there's some of the returns that you could be expecting from purchasing some of these NFTs. I don't know how long that will last, but it's worth knowing about. Then you've got how to buy Bitcoin at an 80% premium from Michael Saylor. So this article talks about how MicroStrategy and Michael Saylor as the CEO is overpriced because they are largely a Bitcoin ETF. They are, the reason why their price has gone up so much is because they purchased Bitcoin. So now these companies are coming in and buying Michael Saylor's company, MicroStrategy, on the stock exchange rather than buying Bitcoin because they want to get in on the price action, and they can't purchase Bitcoin because of their bylaws currently, and while they're changing them and they want to get in the price action, they buy MicroStrategy. But to do that, they're paying an 80% premium for the stock. And then you've got controversial dApps that test Binance Smart Chain's decentralization. So this is all about the battle for decentralization. So a decentralized smart chain is Ethereum, and perhaps a less centralized or a centralized smart chain would be like your Binance Smart Chain. And there's these developers that have built politically sensitive applications on the Binance Smart Chain. So one of the applications is called Slavery, and it's a way of showing that the increasingly popular blockchain platform, Binance Smart Chain, is not as decentralized as Ethereum, because they're daring the Binance CEO to actually take it down. And if he does take down these, politically incorrect dApps, then it's going to show that it's actually a centralized network, right? Or a centralized protocol. Moving on, why Cisco should buy Bitcoin. So I think this is actually quite interesting because we're no longer wondering if companies will be buying Bitcoin. We're now speculating when the next company or who the next company is that is going to be buying Bitcoin. So why Cisco should buy Bitcoin? You know, they're a tech company. They're leaders in their field, they innovate, so there's no reason why they shouldn't be buying Bitcoin. But what they have been doing is decapitalizing the company by giving out $6 billion in dividends and $6 billion to $10 billion in stock buybacks. So they're decapitalizing the company by buying back the stock or handing out these dividends. Their free cash flow, they're giving it back to the shareholders. And what this article is arguing is that give your shareholders value by buying Bitcoin. And as the price of Bitcoin goes up, the valuation of the company comes up. And as the valuation of the company comes up, the shareholders, the stockholders will profit from it. And then we've got Galaxy Digital CoinShares backed Bitcoin mining intermediary startup. So for those that don't know, Mike Novogratz is the founder and CEO at Galaxy Digital, and they're already mega bullish on mining. There's a YouTube video that he did with a lady called Amanda Fabiano, who they've brought in from Fidelity as head of Bitcoin mining, and they're really vamping up their sort of Bitcoin mining team. And what they're trying to do is basically become a one-stop shop for financial services for these miners. So they obviously see the future of Bitcoin mining and perhaps mining other altcoins, and they're trying to get it ahead of the herd. And they're not the only ones. You've got a few companies that are mining. You've got Riot Blockchain that are Bitcoin miners as well. And you've got Marathon Patent Group as well, both of which I'm long on. And then you've got Australian Bitcoin mining firm Iris Energy doubles pre-IPO fundraising target. So they've gone and now aims to raise an investment of $40 million. So this Bitcoin mining space, keep an eye out on that because I think it's set to heat up. And if you've noticed with Marathon Patent Group and Riot Blockchain, they also trade at a premium. So they've got reserves of Bitcoin. They mine Bitcoin for a fraction of the price, let's say $6,000 to $8,000 US. And then they can choose to sell it for the 50,000 or however much it is currently, or they can choose to hold it and borrow against it. And what I'm starting to see is these Bitcoin mining founders and CEOs coming out and saying, we're never going to sell our Bitcoin, or we're going to slow down selling our Bitcoin. And if they don't sell their Bitcoin, they can just borrow against their Bitcoin and raise capital that way. And then that way, as the price of Bitcoin appreciates, they can perhaps sell it down the term for more. So it's quite interesting there as well. And finally, we've got Coinbase, the largest crypto exchange in the US, has filed with the Securities SEC to become a publicly traded company through a direct listing and not an initial public offering. What's interesting is that Coinbase is already in a positive cash flow. So typically you see these companies that are going to IPO, not Coinbase, but if they IPO, they're usually not producing any profits. And one example of that is Tesla. Tesla went public in 2010 and they didn't produce a full year's profit until 2020. Coinbase is going public already in a positive cash flow. So it's super interesting. And one thing that I think is going to happen is that when Coinbase goes public, what we're going to see is these people from the equities market start to prick up their ears and go, oh, wow, Coinbase, $100 billion. That's a huge valuation. And the valuation is going to draw them in. And once they get drawn in via Coinbase, they're going to start looking at Bitcoin, altcoins. So I think this is going to be an alert for these people that traditionally trade in equities. They might go, well, why would I, accept 30% growth here when I can accept 100% growth in the crypto space? And that's happening. You just have to look at Bitcoin. Since March to March, they've gone up 1,200%. You're not going to get that anywhere else besides crypto. So that's all we've got time for today, folks. If you enjoyed today's video, hit the like and subscribe button, and also hit the notifications button so you can stay up to date on our video releases. If there's a topic that you'd like to see on this channel, make sure you let us know in the comments below. Otherwise, we'll see you all next week.